Good afternoon, viewers. Welcome to Macro and Market Moves at Emkay Global. I'm Deepa, part of the institutional sales team, and today we have with us Nirav Sheth, CEO of the institutional business. Good afternoon, Nirav. How are you doing?
Hi, I'm very fine, Deepa. You tell me, how are you?
I'm good. So let's, since we are just entering into May, let's start with your view on the markets first. So which camp do you really belong to? Sell in May, go away, or you think that most of the volatility is now out of it and you're more bullish from here?
So I'm far more constructive. Obviously, three big changes have happened. From our own side, we have got a far more benign fiscal policy, which is very, very critical.
Yes.
Monetary policy, they have, they are providing enough liquidity, right? So you are actually hearing the right kind of music from the RBI governor, which is very much necessary. We'll talk about it in detail, but I believe that was one of the major drags on the economy. Sure. You've seen the credit growth coming down from 15% to 10%. So that needs an uplift. Most critically, I think the biggest data change, and I think we referred to this in our talk before, that India and the other emerging markets were on the wrong side of a very strong dollar trade,
right,
which was essentially a post-pandemic story. So that has changed,
right,
and that means that you will have favorable FI flows. We are seeing that because the dollar is depreciating, and therefore the need to get to sort of diversify out of dollar assets. So you are very uniquely positioned in terms of this geopolitics, and as we now know, finally, Scott Bessent himself talked about the fact that probably India will be the first one of the block in terms of trying to do a bilateral treaty with on trade with US. So I'm fairly constructive.
Okay, so what we saw in the previous 6 months were that a lot of FI selling was there, our earnings were disappointing and all. So picking up from your point that at least the flows have reversed, but that could be attributed to what's globally happening in terms of tariffs and the dollar depreciation. So let's take it from the dollar point of view. It's already corrected almost 8-10%. Do you think that dollar trade will be playing out further and we continue with these buy flows?
So it's very difficult to take a call. I suspect that the final end game around whatever Mr. Trump wants to do, which is trying to inshore manufacturing and trying to create tariff barriers to try and insource, may not be a very, very effective way to try and push that. What probably would happen is that tariff would remain on some of the high valuation sectors. But if you actually want to rejuvenate manufacturing in US, then you need to take care of perpetual overvaluation that is in dollar. I would give reasonable odds of 20-30%, where I believe that Mr. Trump will negotiate very hard with G10 countries to see if there is a concentrated attempt to try and devalue the dollar. So yes, it will require some sort of regulatory intervention, but I think the path for the dollar, the line of least resistance for dollar is down. More importantly, for us to get constructive on the non-dollar assets, it doesn't necessarily mean that dollar has to keep on declining. Even a stable dollar at lower level is good enough. So, and that anyway is a very high probability.
So we are in a space where we don't think that there will be any appreciation from here. It might just stabilize here or directionally be slowly, gradually further depreciate from it, which definitely augurs well for all emerging markets. And then again, the question comes about why India over China, or you think that China with its valuation will attract more flows?
Well, I think it's so much not so much about valuation. We are talking about an economy which is non-democratic, which is on the wrong side of the trade with US. So there are a lot of challenges, right? So you can have occasional rallies because the market is very cheap. But I think that if you take a slightly long-term view in terms of, where you would want to have compounding investment opportunities, I don't think they have got a better opportunity in emerging markets than India, because no matter how you slice and dice, right, we are still talking about an economy that compounds at about 6.5%, which means that the earnings compound at about 11-12%.
Okay.
Within that, you create your alpha portfolio, which is upwards of 13-14%. So there are enough ideas around that. So I believe that I've been holding this view for some time. That the decks are laid up for India to be a very strong outperformer, right? So, and we are, if we take the right steps, which we are, right, in terms of now stimulating the economy, controlling the inflation, the carry is under control, then I think you'll end up being a bubble market over the next 5-7 years. So, yeah, I can't feel more bullish, and that doesn't mean that you're going to rally next week or next month or something like that. If you create a portfolio of countries that you want to invest for the next 10 years,
Yeah.
I have no doubt that India will stand out very close to US.
So clearly, longer term, we are much more sure because we are talking our
Yes.
economy growing at 6.5% for the next 4 years. Accordingly, we'll see
Of
the
course.
incremental market capitalization happening. But let's come back to more near-term outlook. Since we are already halfway through this earnings season, year-end earnings seasons, and that was one of the major reasons which we saw the correction in the previous two
Absolutely,
quarters.
yes.
Now let's break it down across the sectors, and how are you seeing the earnings panning out for the this quarter, and which are the areas where you're seeing some green shoots or improvement, or the slack which was there because of less of government effort and all, which has gone, liquidity measures helping these sectors. So maybe we can talk a little about that.
Right. So my sense is that it's a very good question, and it's not that you've got very easy answers. So, right, we usually try and attribute to any slowdown in earnings to macroeconomic factors, but there are too many moving parts. For example, one of the common narratives, and let's take something like a fast-moving consumer goods. So, I think the fast-moving consumer goods, the problem seems to be slightly more structural because you've got categories which are fully well penetrated.
Yes.
None of these companies are prepared for sort of stimulating in terms of new product categories. None of the companies have done that. Then you are seeing major disruption in their channels, the distribution channels, right? So you've got quick commerce and the impact of quick commerce and the e-commerce on the branded companies,
Sure.
right? Which means, in a nutshell, while the broader economy is doing well, it's a loss of share for these listed entities in terms of a large tail of this D2C companies that have been created,
Right.
right? So it's not very easy to try and say that there's a cyclical slowdown and therefore urban consumption picks up and the companies are going to come back. I don't share that view. Look at banks. Banks, I think the numbers have been reasonably okay, right? But if you again take a 2-year views, and I was just looking at the consensus estimates, then they are in that 9-10% growth rates. So these are very moderate growth rates, right?
Right.
And I think one of the reasons for that is that people are trying to extrapolate what has happened in the current year, which you are looking at essentially a low growth credit phase that you have felt.
Yes.
I think that is being extrapolated.
Right.
And I'm assuming that RBI will be conscious about what is happening, and therefore I expect that the rate cut cycle, this will be fairly deep, which means that you should be looking at outcome, and outcome is a higher credit growth rate.
Right.
So I assume that banks should hold out well. Within that, you'll have companies like newer age companies been very constructive on companies like Eternal, or you got Paytm and stuff like that. So there's a whole new class of these technology companies that will eventually come up and be a part of the Sensex.
Sure.
Capital goods, I think you'll be very constructive. The focus on infrastructure continues. It is not going to be at the same space, right? Because obviously you don't need to keep on constructing the roads, but we'll get into new categories. We're talking about river linking projects and stuff like that. I would like to believe that private capex is to pick up. A lot of this private capex may not necessarily be seen through the spectrum of debt, because a lot of this new age spending that is happening, let's say
Right.
we're talking about data centers and stuff like that,
Yeah.
they don't try and have the same kind of leverage that traditional sectors have that,
Yeah.
but they still contribute to the economy,
Right.
So, and yes, of course, real estate is something that has been the engine of growth,
Yeah.
and I think that will remain for a long period of time. So, and that is 1/3 of my capex. So, capex, consumer discretion, which is largely more on the durables, under-penetrated categories, or even something like two-wheelers, and even broadly as a category, we still look at automobiles. I think those should do well broadly.
Broadly, these are the sectors
Yeah.
you're bullish on. But within this space, one challenge which India has always faced is valuations. As a country, our valuations, if we talk about September 24 to now, have definitely corrected.
Right.
The froth has gone. But can I say that they are really cheap and we are like, we can go all out and buy? Do you think that is there any pocket in the market which looks like that? I think financials was one widely spoken in the last 3 months, but that has also caught up in its
Yes.
movement in the last quarter. So where would you see that there would be some decent valuations, even if not cheap? So where would you look at those?
So I sort of concede to your point that valuations are not cheap, but it is unlikely that So when you create a big portfolio, and I'm talking more from an institutional perspective, right? When you want to put in billions of dollars, you're not necessarily looking at pockets of serious undervaluation. You are trying to see, where would you get reasonable risk-adjusted returns. Secondly, we always have to appreciate that returns are always relative, right? So it is a sense that, I've got a pool of money and that is to chase, let's say, China or a Brazil or a US, or whether it's a dollar asset, it's a dollar related return, it could be in euro. In that context, we stand out. Now, does that mean that, should India deliver about a 12% return in CAGR term? That is very, very likely. So I'm talking about the Nifty doubling somewhere between 4.5 to 5.5 years.
Right.
That is a high probability wager that I'm willing to make.
Right.
And then you try and, like I said, this is blind bet on the Indian economy. And you will struggle to find out how many countries can deliver that kind of returns. So what essentially you think that it is not necessarily cheap, could be a reasonable level of return for someone who is sitting outside the world, because your dollar returns are likely to be more than 4 or 5%, right? So, and like I said, anything more than that, then you try and go down the risk curve, or you get into more inefficient sectors. We've always liked SMEs, right? So, a lot of the opportunities in our country will continue to remain those
In a small
25, 30% growth rate opportunities will be there in the SME sectors.
So let's, since you mentioned that you expect the Nifty to almost double in the next 4 to 5 years, that's your timeline. So the way we saw it in this current quarter, the underperformers started coming up and becoming market performance, like the banking sector, the private banks, which had done nothing for the past 3 years, are now coming as market. So do you think that there would be a rotation across, since because there are pressures at IT, which has corrected recently, the FMCG pocket of the thing, the construction, the L&Ts of the world, which have done nothing much in the past 2 years. Do you think that kind of a rotation happening in the sector anytime soon?
Yeah, of course it will happen. So, like I said, for example, because I have got a slightly negative view on dollar, and I suspect that you will see US has got its own problems. All of us know about the ticking time bomb in terms of debt, so they need to solve that, and therefore we got a slightly more negative cyclically on software, but these are still very high free cash flow companies. But then valuations are corrected, right? So you're just looking at a time when you can comfortably say that, okay, US is turning the corner.
They have been the favorites of foreign investors.
Absolutely.
So at a decent valuation and a little more stability in terms of growth,
of course, investors will come back.
Even come back to these
Absolutely. And likewise, I think L&T, a lot of the things that are happening, it is very difficult for you to model right now. For example, nuclear power is in some sort of renaissance, right? There are very few companies who can pull that off, right? So L&T benefits from that, right?
Yeah.
We didn't talk about power, but as a matter of fact, I was just, looking at an Instagram snippet of Eric Schmidt, the ex-Google CEO. And it's not funny, some of the statement he has made. So the data centers account for about 3% of electricity consumption in US.
Yeah.
And he says that it is quite likely that in the next 7-8 years, it could be 99%, which means that you just don't have enough capacity to supply to the huge demand for data centers. Now, this is not necessarily just an US story, right? So the explosion that we are seeing in AI is also going to be in India. So all these opportunities are going to open up. Right, so you need to then try and see how do you try and place these bets, and all these companies will be front leaders in there.
But let's look at it the other way around. Like if you talk about semiconductors or AI or data centers, This story has been played out for
Of
the
course.
previous 5 years, right? The valuations are capturing the kind of growth these sectors would witness over the
Right.
next 5 to 10 years. Do you think the allied ones, the typical brick and mortar sector, maybe a power equipment, maybe a power generation capacity, a transmission capacity, or maybe basic cement for your constructions and all, do you think we will come back to the traditional investing for the next 3-4 years? They have been laggards in terms of their valuation. There's a little more comfort there. Do you think a rotation coming out there?
Yeah, so I think, for example, transformers have done well. Some of the utility companies have done reasonably well. So certainly they are going to come back. I also forgot to mention that let us see how the trade treaty plays out. So
Yeah.
we know very clearly that there is a big push to get out of China, right? So we've been talking about China plus for a long time, but we are surprised, and this is also what my team tells me, that the initial feelers from US companies trying to diversify out is huge. So we always would appreciate that in the last 20 years, India was never a part of the supply chain dynamics.
Yes.
Right? Which is why
Yes.
when you say that, India is least affected,
Yeah.
because you never played that game.
Yes.
Right? So you're not losing out.
Yeah.
Now is the time to try and capture that. So we'll
Right.
see how this evolves.
Yeah.
Right? So
India being the part of the Quad will change a lot of dynamics in terms of its export and
so a lot.
trade
So
culture.
some part of valuations are obviously in the
Right.
play over
Yeah.
there, that you can suddenly, the Dixons and the Foxcons of the world and Tata's unlisted subsidiaries.
Sure.
These are very big opportunities. We are talking about some seriously high growth rates, and this is not only from investment perspective, but this obviously has a big impact on the economic activity. We've seen what has happened to GCCs, right?
Yeah.
They are 30% now of
Yeah.
my software exports, and
Yes.
while my software exports are just about 7% growth rate, GCCs have grown 30%, right? So then it adds to my housing demand and stuff like that.
Yeah, that sums up a lot, that there would be many new opportunities.
coming up.
Obviously, the traditional sectors might do well, but there would be new pockets emerging for
Absolutely.
investing. But let's go back to currency again, because if we see the dollar has depreciation, but so has rupee depreciated if we take the last 5 to 10 years, right?
Right.
What is the direction for rupee for you from here? Because that also impact the variation on the sectors and thus all the commodity plays. And do you think that gold as an asset class will become a replacement to a reserve currency, or is just a momentary run because of the uncertainty in the environment?
So let me take both the questions. So rupee, finally we have to appreciate that if I have got an inflation differential which is significant from my trading partners, eventually that will reflect in how I'm going to depreciate.
Sure.
And if you now look at the last 5 years and preceding 5 years, then you've seen a significant slowdown in the rate of depreciation. I think it's just about 2.3%, right? Which is great, because obviously other countries have also inflated up and we've done reasonably okay in terms of inflation. Do I expect rupee to remain flat? Maybe the answer is no, because we are still a current account deficit country, whether we like it or not. And let's see how well we can get up into the supply chain and whether we can change the dynamics and all. But I could go out and make a bold prediction that our rate of depreciation will be significantly slower than what we have seen in the past.
Yeah.
Which itself is a big, and I think this matters to my consumption abilities and stuff like that. So on a very near term basis, because there are a lot of technical factors at work, I suspect that will be flattish given our perspective on what is going to happen to the dollar.
Right.
And your second question was around
Gold as
gold.
an asset
So
class.
I was always of the view that gold will end up being a fringe asset class for the central bankers. I suspect a couple of things have happened. Obviously, with the Russia-Ukraine war, and then you forfeited the forex reserves of Russia, right? So that is a signal to the outside world that powerful countries can act unilaterally, whatever, and so this is a big loss, which means that there'll be a lot of central bankers and countries where they believe that they want to diversify away from dollars, and therefore gold remains a dominant part of that. Secondly, we may keep on arguing that like Mr. Warren Buffett famously says that, gold is an asset class that doesn't produce any cash flows, and it only depends upon whether the next guy is willing to buy at a price higher than what you paid, right? But it still has a very, very significant monetary value, right? So, including the psyche of people from thousands of years trying to, and very liquid and holding gold and stuff like that. So, just from a near-term view, the prospect of dollar depreciating, the prospect that there could be an accord where Mr. Trump emphasizes the need to significantly devalue dollar, right, will certainly make that appeal of gold far more, which means that the institutional buying in the gold can be significant over the next couple of months. Till the time we don't sort out this, what is the final agenda that Mr. Trump has got in mind. So from very near perspective, I don't try and look at, whether gold is up 30%, it might as well go up another 20%. So to me, I'll try and predict the direction. Direction for me, for the gold is up. Till that time, I change my view.
Okay. But do you think there is any other currency in the world qualifying to become a reserve currency like dollar, which has been there since Second World War?
It won't happen in my lifetime.
So it could be directionally for some
directionally,
time,
yeah.
but you don't have an existing currency.
You don't have an existing currency. It's a democratic country and it's a great country, right? So right now they're going through pain problems. I think they are far ahead in terms of AI.
Yeah.
The applications of AI are going to be massive, right? So it's an economy that has done significantly well.
Right.
So I think we'll stop worrying about it after some period of time, right? They have got a debt problem. They have to sort it.
It would be an interim correction for what they want to do with their own economy.
Absolutely.
But overall, it doesn't look like that dollar would
right?
lose its sheen.
The invoicing is 70% is in dollar invoicing. China is a non-democratic setup, right? So I don't see any way outside dollar.
Okay, great. That was very enriching what we heard from you regarding the economy and what you think about the things. Last but not the least, which has been the latest area of discussion for our market, is the geopolitics. What will happen because of the terrorism we faced in one of our states. So what's your view on that and its impact on the market?
Well, so I have no doubt that there will be military retaliation, the way I look at it. Whether we like it or not, it is important to take some actions which acts as a deterrent, right? So you did it in 2016, and then you had Pulwama attacks, and then you again had surgical strikes, and that worked for 6-7 years, and then it sort of tends to, people take it, get too much of, derive too much of comfort. So I believe that there will be significant action in some form. It will also happen, I believe, in a construct of having a lot more buy-in from the international guys, right? So you've seen the recent statement of UNRC, which unilaterally condemned the terrorist activities in the state of Kashmir. Which I believe would significantly limit ability of Pakistan to retaliate in a significant way. From our perspective, we need to be very clear, and this is a challenge because I keep on thinking about what is the right way to do it. We always have to appreciate the fact that we have very, very strong economy growing and taking our rightful place in the world. In a couple of years, you will be third or the fourth largest economy in the world. So in a way, to get into a situation where there is a protracted battle is actually going to harm us. We have a lot more things to lose. It's a bankrupt country on the other side, so there's nothing much to lose, right?
Yeah.
So you need to do it in such a way that there is significant action, that is, you communicate that you will take this very, very seriously. At the same point of time, you should also be able to disengage very quickly and focus on development, because finally it's development that makes the country very, very powerful.
Sure. Could I like to wind it up with one last question from you? We had seen Nifty going up to 26,000 plus without the support of the FIs. Then we corrected with further selling and whatever global tactics happened. Now we are back in a scenario where we have positive flows from the domestic buyers, from the international buyers. Earnings are improving. What is your near-term target on Nifty?
So my sense is that sometime by Diwali we should be making new highs, right? So a lot of this I'm basing on the fact that we'll see significantly more cuts in monetary policy. So I
Right.
think the attempt by the RBI to stimulate the economy is probably their intention is far more than what the markets are pricing in. I don't think that a country like India should be looking at 10-11% credit growth rate.
Right.
And if you are stuck at 10-11%, which means that you need significantly lower real rates to try and drive the economy forward. And I am assuming that RBI is cognizant of that, right? Which is why you are seeing some of the actions which are very, very encouraging in terms of creating liquidity, changing the stance to accommodative.
Right.
And if that happens, then I think then we'll see upgrades in economic growth rate and earnings. So that becomes my base case scenario. And markets are a discounting machine, right? So
Yeah.
I'm assuming that by Diwali you should have far clear picture of what happens in FY27, and that should take you to newer highs.
So if we really reach there, new highs by Diwali, we'll be again back to double-digit returns in a span of
Absolutely.
5 years' time.
Absolutely.
That's a great thought and a great way to end the conversation with a positive note. So please, viewers, don't sell in May and go away. Try to find in newer pockets of investments. And I hope you found this interview enriching. If you have any further questions, you can write to us. Please subscribe to our channel. Thank you.
Thank you.